Hello everybody, welcome back to the Cyclical Investors Club YouTube channel. Today we're going to be looking at a Pepsi stock. This one came in by request. If you are watching this video and you would like me to do a video analysis of a stock, just drop it in the comment section and I will put it on my list and I will make a video. If it's in the S&P 500, as part of the S&P 500, I post those for free on YouTube. If it's not in the S&P 500, I post those on Patreon and in my investing group, the Cyclical Investors Club, which there are links in the description for that. If you join Patreon, you get a big discount if you decide to join the Cyclical Investors Club group. So you can check that out if you would like a more full service where you can chat with me. I have all my spreadsheets open there so you can use them, and there's all kinds of other good benefits there. As always, this is not investment advice. I'm just sharing my way of analyzing stocks and how I do it. And I think that's about it. So I usually like to start my articles when I'm writing over on Seeking Alpha, and also videos when I can, if I've covered something in the past, to look at how my suggestions, my ratings have performed in the past, so we can get an idea of whether my techniques work, because I don't spend a lot of time making up stories. I mean, I'll kind of share what I think might be going on with the business, but I start with the numbers first, and then if the numbers look interesting, then I dig more into the business, because I can cover a lot more businesses faster that way. And so I'm less likely to miss ideas. So I've only written one previous article on Pepsi, even though I've tracked it for a while. That was all the way back in July 26th, 2019. It's a long time. That's over 4 years ago now. But the thing is, with valuation analysis, it can take 2, 3, 4, 5 years sometimes for that valuation to kind of be recognized by the market sometimes. So unless something strange happens in that time period, which we did have COVID, which was strange, it's still relevant. If I haven't updated this, it's worth looking to see how it did. So I rated it a hold at the time, and its total return has been about 41%, almost the same as the S&P 500. That's exactly like what a hold you would expect from a hold. So I would consider that a pretty successful rating, at the time. So let's move on to Pepsi now. I think they just reported earnings not too long ago, a couple weeks ago maybe. So when I do these valuations, the first thing I check is earnings cyclicality. How cyclical have earnings been historically? I don't use categorizations by Wall Street, although they are usually pretty accurate in terms of what's cyclical and what's not. I look at the individual business, I look at the history of the earnings, I see how much they fluctuate, and that's what I use to determine what style of analysis, because I have more than one style of analysis depending on what type of business it is. So with Pepsi, it's not very cyclical at all. This green shaded area is the earnings and the earnings per share over time. Every now and then they'll have like a single digit slow year. They had a couple up here, we'll see when I shrink the graph. But overall, earnings are very stable. So I wouldn't consider this cyclical really at all, or particularly economically sensitive, but there are definitely slow periods in here where earnings aren't growing a lot. Also, some people have sometimes a mistaken assumption that just because a business's earnings are stable means the stock will be stable in a recession. But I think if we just look at Pepsi, which had a pretty high valuation in 2007, around 23, if we look at what it did back then, the stock fell 40 to 50%. So we'll call it like 40%. That's a less than the S&P 500 fell, but it's still a big decline. So I think sometimes I run into people who feel safe if they have like a consumer staple stock, when cash or something similar to cash would have been better, because they think it's going to be safer during a recession. Okay, so just be aware of that. These stocks can still fall a lot. If we look at the peak right now, it was actually high. It was a 27 PE peak. So chances are, if we had a similar event as 2008, it'd probably fall more like 50% or 55% if the same pattern played out. So that's worth keeping in mind if you own Pepsi and you just want to be safe. Now, if you're a money manager and you have to be invested in stocks all the time, if that's your mandate for whatever fund you're running, then you'll go buy something like Pepsi because it's relatively better than the rest of the market during scary times. But as individual investors, we don't have a mandate where we can do whatever we want to with our money. We don't have to be 100% invested in stocks or 80% or whatever the fund is. So that can be an advantage that an individual investor can have over certain money managers. It all depends on what kind of fund they're running. So I've done pretty good, I think, with Pepsi in the past. I don't hate it or anything like that. Let's see. So the next thing is to choose a time frame we want to measure earnings growth from. The standard I've been using lately is 2015. That was kind of a weak year. It was actually a little weak for Pepsi. It was definitely weak for industrials. It gave me a little bit of a recession in there. And then it really depends on the company, how 2020 worked out in terms of a recession. It was great for some. It was bad for some. It was just wild for some. For Pepsi, it's kind of similar to what you would expect during a typical recession, I guess. I mean, earnings were kind of crummy for 2 years, but they weren't horrible, right? So that gives you a pretty good balance in a long enough time frame. This is going to be a 9-year time frame where I can kind of go through here and try to figure out what this long-term earnings growth trajectory has been. Now, honestly, if I went back to before 2020, I would go back to like 2007 or 2006. So, if I was, in 2019, I did do this. So if we just go back to 2019, this is probably what I would have been looking at then. I would have gone all the way back here and gone through the same process. I'm not sure. I could go read that article and see what earnings growth rate I came at. But at 5.43% is roughly where Fastgraphs is. Mine would have probably been a little lower than that because I take into account these slow years. But you can see that because these earnings are so stable, there's nothing like super crazy going on. 2015 to 2023 should be just fine. That time frame, it should work just fine for us. I don't see any reason to kind of change that. So we have the time frame we want to work with. Now what I want to determine is what the earnings growth rate is. And so the way I do this is I go through each year and I calculate if you took $100, how much would it grow based on these earnings growth rates over this time period. And I count the down years too, which a lot of people don't do. Doesn't make a big difference with Pepsi because their down years are pretty puny. And then I also use the forward earnings year. So I'll look ahead to the end of the year, and whatever this estimate is, that's what I'll use for this last year. Additionally, I also control for share buybacks because these are earnings per share. So if the company is buying back a lot of shares, that will inflate this growth number because there's fewer shares. And I want to know if they didn't buy back shares, how much would the company be growing? That's more the estimate that I care about, like from a business owner's perspective. And so they bought back about 7% of the company's shares. So I would try to my best. I just do a quick estimate. This isn't like a deep mathematical problem. Mostly it comes into play if companies are buying back a significant amount of shares, so their EPS growth can look fantastic. But in reality, it's not really that good. It's just they keep buying more of the company, so there's like less of it, which is totally fine as long as the company's growing from an investor standpoint. But it doesn't necessarily reflect the true value of what the business is actually growing at. Okay, so when I do that, when I run that calculation, I get a 4.69% earnings growth rate, which if you looked at that old first time frame I put up, that's almost spot on probably to what that would have been. So once we control for the buybacks and the down, every now and then have kind of those down years, this is kind of the earnings growth rate we're looking at. Now, if this earnings growth rate is below 4%, I usually avoid buying the stock. I might not sell it necessarily if I already owned it. But we know that, inflation's been running more than this recently, but over this time period, I usually just assume inflation is going to run 3% over the very long term in the US. So this is a little bit faster than inflation, which is fine as long as the rest of the valuation works out. So this is a slow grower, but it is growing. They are a high quality company. They have the ability to pass inflation on to their customers, which we actually saw in this recent earnings report. I didn't dig through it. I just saw the headlines and I was like, oh yeah, you can just see that they're able to raise their prices and people are willing to pay them as long as they're reasonable. So high quality business, that's what we want. Earnings growth is adequate, but it's not fast. Okay. Let's see here. So the next thing we want to know is what the earnings yield is. So the earnings yield is the inverse of the PE ratio. Often you'll see PE ratios. This would be the forward-looking one. I don't know if I may have adjusted this one for debt, so it might not perfectly match up. Actually, let me check the fast graph real quick. Fast graph uses a blended PE. Let's see. Oh, we're right in the same ballpark. Okay, so we're basically the same here. So we have this PE. If you invert it, you get, like PE is price over earnings. If you change it to earnings over price, it creates this percentage. This is a percentage, 4.09%. That's the earnings yield. Now, the way I like to think about this is if I bought this whole business for $100, it would earn $4.09 a year. If I owned the business, I could just take that $4.09 and, pay my bills, go on a trip, do whatever. And then that $4.09 would grow at 4% and 4.69% a year. This is all just estimates, by the way. So don't get too caught up in like the details. We're just trying to get a rough valuation. So we have our $100. The first year, I usually pull the first year forward, so I give it the growth from that first year. So $4.28 the first year on top of our original $100. And then that $4 grows at 4.69% for 10 years. The $104 does not grow at 4.69%. So that's another thing I do a little differently. Just the $4, but you collect it each year. So this is the cumulative effect of you collect this $4, you collect this 428 plus 4% or whatever, and then that's what this is set up to do. And then after 10 years, I look and I see how much money I have more than my 100, and it's $153. So you make $53 over 10 years on a $100 investment. And then I convert that to a CAGR. So, and that CAGR is 4.35%. So if you're going to go buy, I don't compare this to the 10-year, a lot of people compare it to the 10-year treasury, which I think is like 4.9% or something right now. So, but that treasury cannot raise, it will not raise at the rate of inflation. So even if you hold it to maturity, you just get your money back plus whatever the coupon is, the 4.9% a year. And in this case, let's say inflation came in hotter than it did historically. Let's say inflation was 4% a year or 5% a year. Well, Pepsi is probably going, all other things being equal, probably going to be able to increase this earnings growth rate from 2015 to make up for that higher inflation. So you get an inflation protection if you're buying a high quality business, usually if it's like a good one that a bond wouldn't have. But usually what I just have a standard that I use no matter what the treasury market's doing. And that's, if this is below 5%, that's just too low for me. I would rather find a different investment or hold cash for a while, which is actually yielding more than 5% now, and wait until I can get a better price or a better deal somewhere. If not with Pepsi, then with some other company, right? So for me, because this is so low, it would be a sell. Now, when I did this back in 2019, it was a hold, right? So the valuation has gotten worse since then because the price has risen. The price has risen faster than earnings. So this would be a sell based on valuation alone. Nothing wrong with the business. Business is okay, but it's too expensive. So the next question would be, when would I buy it? And I'm going to give you the simple calculation on that is when the price falls, this CAGR goes up because you're paying less for the business, right? And you get to keep more earnings relative to the amount that you paid. So as this goes up, when it gets my personal level is about 8%. So when this gets to 8%, that's all other things being equal, that's a buy, right? So it would happen if everything stayed the same and nothing changed but the price. If the price fell about 54% down to 74.20. Now this isn't a prediction of whether it will fall that low. It's just I'm not buying it unless it falls that low, right? Based on these basic metrics. Now, one caveat to this is because there's probably a recession coming or a recession is high, I have another price that I use here called my recession price. Now, typically for a company whose earnings haven't started falling like before a recession or during it, this recession price is lower. So for the majority of stocks, this buy price will be lower than the standard one. But because Pepsi is a staple, right? The way I determine the recession PE is to look at past recessions and how the stock has behaved. And as we saw, Pepsi stock did fall 40%, but their earnings actually rose through this time period. So they aren't really affected by recessions. There are going to be people that do, even though I said it's not a safe haven, some people will treat it as that. And so it doesn't tend to fall as much as the average stock in the market. And if you take that into account, and maybe you just like Pepsi, like this is the one you want to own. You understand it. You don't follow 600 stocks like I do, and you have your target on it and you're like, I want to get the best deal I can on Pepsi. Okay, so that's a way to think about this too. In the next recession, I want to buy Pepsi. I know I want it and I want to get the best price. So that's kind of what this recession PE is for. And because it was so stable, people were willing to actually pay more than I would, is a good way to say it, during the 2008 recession. And so probably based on history, people are not going to let me get the price that I want. But if we have a recession, you might be able to get it around 102. So the way that I base that is, let's see here. I basically try to take the most pessimistic PE ratio, which I call the recession PE. And what it does is it takes the low price during the last recession or a recession or a down period or whatever, and the peak earnings. Well, in this case, I probably used their earnings didn't exactly peak in 2009, but I don't know exactly which year I picked. These are close together. So I would have picked one of these 2 years, probably this one because it's in the middle of the recession. And I would have created a PE ratio from this earnings amount and the low price. So the most pessimistic PE that it had, and it can even be mismatched. Like the price might fall in 2009 and it might have peaked in 2007 for some stock. That's okay. I want the peak PE because that will be stable when everybody starts freaking out and earnings start falling for a lot of stocks. Pepsi's a little different. And so that PE, it was actually, if you look, it's pretty high. It was 11.9 during 2008. And what I do is I say, okay, I want to get close to that, but I'm not going to assume that we hit the exact bottom that we hit in 2008. So I add some percentage of cushion to that. In this case, I added 30% cushion. So 30% above the 2008 decline, and that works out to a 1547 PE. Now, an important thing to point out, I'm getting really kind of detailed here and into the weeds, but I know there are a few people that are going to try to do this themselves. And so an important thing to point out is that, let's say this year comes in good, we have a recession in 2024. Well, let's say these earnings drop from 755 to 720. For some stocks, they can totally fall off a cliff. But in this case, they don't. I would still use this number here to determine the PE if we're in a recession. So eventually, assuming that they hit this number will be stable even if they're struggling next year. So I'm not constantly getting more and more pessimistic like the market's going to be. It's basically a way to assume that we'll have some kind of recovery down the road, and that earnings will eventually recover this and along that stock price. So there's a lot of that's built into like the thinking behind this. And Pepsi's not a perfect stock to do it, but it is kind of interesting to look at it. So at any rate, we want this $21 or 21 PE to get down to 15 before we buy, using the method that I just explained. And if it does that, it only needs to fall 36% to 102. Additionally, this number is adjusted for debt. So debt and other obligations. So the way that I do that is I look and see what the market cap is, and then I look and see what the total enterprise value is. And I see how much of a percentage higher the total enterprise value is from the market cap. And I adjust, just for stock purchasing purposes, the stock price for the amount of debt basically and obligations that they have here. And so I will pay more for a company that has less debt and less for a company that has more debt. And in Pepsi's case, they have about average debt for the S&P 500 company. It's like 14%. So I'm going to require, the stock price right now is 162. I treated it as it's really trading at 184. That's one way to think about it. So that's built into this formula here and into this price. So if you really want Pepsi stock, this is right about the price that I would be willing to buy it if I was a big Pepsi fan. And if you just are aiming for, the best return you think you can get based on the earnings of the business, then something closer to 74. I could see if it actually would have done that. Let me take off my cushion here. We'll see if it actually would have hit that metric in 2008 or not. Bam, almost exactly. So if we had a bad recession, I still got a shot here. But it would require kind of a perfect storm probably of negative events for me to get the price that I would want. But there is a chance. I mean, basically it did this in 2008. I would have had a chance to get it at a great price. So it's not totally crazy. The prices I would be willing to buy aren't nuts. They do have a chance of happening. The way I think of it is I don't need every stock to hit. I monitor hundreds of stocks. Usually I have about 300 high quality ones at any given time that I'm just waiting for the price to hit. So if you think of just 10% of those hit, that's like 30% or 30 stocks. And so I'm pretty patient because I watch so many stocks. Not too much is going to slip by me if it's an obvious one. But not everybody can be in that situation. If you join the Cyclical Investors Club, though, you get access to all that. So it's something to consider. Okay, that is going to be it for this video. I tried to go in pretty good detail and hopefully explain this in a more systematic way than some of the other ones I've winged a little bit more. I'm going to be putting out a lot of videos, so make sure to subscribe if you like this style of analysis. Make sure to leave your requests, and we already have a pretty good list that I have, and we're going to keep rolling them in. Thanks for watching, and I'll see you guys later.